You're not going to want to miss this, folks. Podcast on Mortgage Frequently Asked Questions with mortgage expert Nat Ruta. Please note the full disclaimer here, which is also located in the About section of my YouTube channel. And welcome to the first ever podcast for my YouTube channel, Get Rich Investing in Toronto Condos. I'm very, very excited today. I have invited Nat Ruta, a mortgage expert who has a great deal of experience in the mortgage and finance fields. So, Nat, thanks for being here. I really appreciate it. How long have you been doing this? Go ahead.
Yeah, hi, Rick. Yeah, thanks for having me on. Really appreciate this. I've actually approximately 20 years, give or take, I've been in the finance and mortgage sort of industry. So we had quite a bit of experience. Don't want to say I'm too old, but definitely I have been around. And so sort of my forte. Finance has always been an area that I've had a lot of interest in. So,
well, that's perfect. Excellent. So, again, I brought you on to get your expert opinion on some of the common questions that I get from people that are either subscribers or ask me questions through my YouTube channel, or that have purchased and read my book, Get Rich Investing in Toronto Condos, available on Amazon.ca.
Yeah, and actually, congrats. I definitely want to congratulate you, Rick, on that. I have read the book. Definitely, it's a perfect book for someone wanting to get into the real estate investment market. Very easy to read, straightforward, step by step. Definitely a must read for beginners as well as novice real estate investors. So anybody who might have a little bit of experience, I think they'll learn a few things from this book. So congrats on that, Rick.
Hey, thank you. Thank you very much. So let's dive into the first question. What is the typical down payment that someone would need for an investment property such as a condo, and is it different than buying a primary residence? Again, that's one of the biggest questions, one of the most common ones that I get.
You know what? That's actually a very good question, Rick. There is definitely a difference between a primary residence and an investment property. So there's a lot of factors, and different lenders have different rules. Generally speaking, at this moment in time, if you're looking at a rental property, you require, I'm going to say, at least 20% down. So There's no lender that will do less than 20% down on a rental investment property. If you're looking at a primary residence, Rick, then you can get away with less than 20%, and in some cases as low as 5%. So that would be the main difference between the rental property and a primary residence that's owner occupied.
Wow, gotcha. Okay, sounds good. So basically, if I'm buying an investment property worth, I don't know, $500,000, then 20%, I'd have to pay a down payment of $100,000, right?
Correct. So in that case, being an investment property, 20% of 500 would be $100,000. So you'd be borrowing $400,000, and that's what you need to qualify for. So you definitely would have to qualify through a lender for a $400,000 mortgage.
Okay, perfect. Understood. So then another common question that I've been getting, and I'm sure my viewers would be curious about as well, is in general, what are the typical things that a bank or other lenders look for when giving somebody a mortgage, like when qualifying them? For example, on this rental condo scenario.
Again, that's another very good question. A lot of lenders have different criteria, Rick. When we talk about lenders, I mean, we can really elaborate on this question, and not to elaborate too much on it. Whether you have the the primary lenders, the A lenders, as we like to call them, Schedule One banks, and then you have the Alt A lenders, B lender, and then you have private lenders, which is equity lending and so on. But we'll keep it simple. The main criteria would be age of building, market rents of the unit, if it's currently not rented out. So they'll look at comparable units and what they're being rented out for, and then they'll look at the applicant, the main applicant, in this case being the buyer, income of the applicant, assets, debts outstanding, and then obviously the credit score. They always run a credit check, and definitely there is a score that they look at, and there's a minimum score that a lot of lenders will require in order to lend you money. And again, this varies. Getting back to the A lenders and the B lenders and the private lenders, it definitely varies depending who you're dealing with it in terms of a lender.
Okay, that sounds good. So, am I correct in the assumption in saying it'll be easier for, I guess, a couple that brings home a higher household income, just generally speaking, to qualify?
100%. If you have, you have a couple that has a higher income than say one applicant, and then we also look at, again, getting back to the other debts. Is there multiple investment properties that couple or that one applicant has? That's another factor that a lot of lenders will look at, and then they'll start getting into other calculations when there's multiple investment properties. But again, that's another topic that can also be elaborated on. But trying to keep this as simple as we can and easy to understand. But the higher the income, the less the debts outstanding, the easier it is to get an approval.
Gotcha. Makes sense. Thanks. Now, since you've mentioned a market rent, I've had a few people ask me what actually happens if the investment condo that they're looking at at buying is currently not rented out. Does the bank even factor in rental income? How does that all work?
Sometimes I've questioned myself and said, how can a bank lend out money on a unit that's not rented out? And, it just puzzled me. But, when you look at a market like Toronto, Rick, a city like Toronto, which is a world-class city, I don't think many people have problems renting out a condo in Toronto. So that's one factor the banks look at. So, if you have a unit that you're buying or a condo and it's not rented out, there is something called market rent, and it's part of the appraisal process. So an appraiser will go out and appraise the property, and at the same time, they'll look at market rent. They'll look at comparable units in the building. They'll look at the area and do a comparison of, let's say, 3 similar properties, and then they'll come up with a market rent for the calculations. And that's used in the debt service calculations that the bank use in order to figure out what the maximum lending amount would be.
Okay.
So yes, to answer your question, lenders will lend on a property that is currently vacant.
Okay. Yeah, because I did always question that. I'm putting myself in the bank's shoes, right? Putting my bank hat on. And I found it quite interesting, right, that the bank would lend you money on on a vacant unit.
Yeah. There is, maybe I should bring one thing. There is always one downside to that as well, of having a vacant unit. I shouldn't say that's exactly the same as having a unit that's currently being rented out or with a tenant. So lenders sometimes will say, if the unit is vacant and once they determine the market rent, they may ask for a slightly higher down payment, Rick. So I've seen cases where lenders, instead of asking for the 20%, which is the minimum down, they may ask you for 25. In some cases, I've even seen them ask for 30% down. So it all depends on the lender. It all depends on the building, the applicant, the income, etc. So there's a lot of factors that come into play there.
Right. Okay. Okay. So let's see what else we've got here. Yeah, that's actually great. Thanks for that. That's very, very informative, and I'm sure the viewers as well appreciate your great insights.
Yeah, I do. It's not a problem, Rick. I really had a lot of fun. Definitely, it's something that I look forward to. I definitely look forward to doing some more podcasts in the near future. I'm sure you'll have a lot of your viewers and subscribers that'll definitely want some more answers to certain questions. We can dive a little deeper in future podcasts. Anything else your viewers might be curious about, I'd be definitely glad to basically come again and answer a lot more questions in the near future, for sure. I really enjoy this. It's something I definitely look forward to.
That's awesome. That's awesome. Well, I'm really excited. That's fantastic. And yeah, speaking of the viewers, and if any of them had any burning questions, right now, or wanted your free expert advice on how you can help them with their personal situation, whether it be for their primary residence, a rental property, and I know you even do commercial. What's the best way that they can reach you?
They can look me up actually on LinkedIn.
Yep.
If they, I'm not sure if you have a link there, but if you look me up on LinkedIn, go under Nat Ruta. So first name being Nat, Nat, last name being Ruta, Ruta. They can also email me, Rick, at my email would be Nat, so NAT, at yourmortgageconnection.ca.
Perfect.
So,
yes.
I'd be more than glad, Rick, to answer any questions your viewers or subscribers may have, and definitely look forward to doing this again.
That's excellent. I'm sure you can handle any of their mortgage needs, so that's fantastic. That's perfect. I've got that information up on the screen, your email that they can reach you at, and I will also put that in the video's description, as well as the link to your LinkedIn profile. So thank you so much. This has been fantastic. Viewers, everybody, if you've got value from this podcast, please hit the like button and comment below with any questions or ideas for future podcast topics.
Well, thank you, Rick. Look forward to seeing you again.
Yep. Thanks again. Have a good night, Nat. Appreciate it.
Have a good night. Thank you.
Okay. Bye-bye.